We often fall for the income illusion, the belief that earning a six-figure salary will automatically solve our financial problems. In reality, if your underlying spending habits are flawed, a bigger paycheck only accelerates the damage. Think of your finances as a metal bucket. Earning more money is simply pouring water into a bucket that is full of rusted holes. The more you pour in, the faster it leaks out. Over the next few minutes, we will map out a strategy to secure your financial future. You will learn how to build a strict 50-20-30 budget, optimize your credit score, and identify 3 specific leaks you can plug immediately. Step 1. Pause this video. Gather your bank and credit card statements from the last 90 days and open your preferred budgeting app or a blank spreadsheet. Organizing your data is the first step in moving away from reactive spending and toward a more disciplined approach to managing your cash flow. We start with the first pillar of your financial blueprint, your personal reputation. Trust functions as your primary collateral in the business world. It is a tangible asset that opens doors to future growth. Take your spreadsheet and write down any professional or financial commitments you have made recently but failed to honor. Make a specific plan to fulfill those obligations today. This exercise matters because of the trust equation. Competence without character renders you untrustworthy, while character without competence makes you ineffective. You need both to gain access to future capital. A damaged reputation is the most expensive financial leak you can have. It closes doors to business partnerships, bank loans, and the leverage you need to scale your finances. Without establishing a baseline of trust, higher-level financial strategies remain out of reach. You must prove you can fulfill the commitments you put in place. The second pillar is your strategic credit. Pull your correct credit report now and scan it line by line for any fraudulent accounts or reporting errors that may be dragging down your score. Your consistent payment history makes up 35% of the calculation. Next is credit utilization. On a $10,000 limit, your maximum safe threshold is 30% or $3,000. For the highest bracket, keep the balance below 10% or $1,000. While managing these balances, avoid opening multiple new accounts in a short period. This artificially shortens your credit history length and average account age. Strictly adhering to these utilization metrics directly lowers your cost of capital. It ensures that when you use debt to buy assets, you are paying the lowest possible interest rate. Now look at the specific banking tools currently holding your capital. Check the interest rates you are earning on your deposits. This visualization compares the stagnation of a basic savings account earning 0.01% against the growth potential of a high-yield savings account. Log online or visit your local branch today to upgrade your standard savings to a high-yield account that offers competitive interest. If you currently have no credit history, apply for a secured credit card. You can use your own cash deposit as collateral to safely build a record of on-time payments. Leaving capital in a low-yield account is a passive financial leak. Moving that money to a high-yield account forces it to actively grow. The final pillar is cash flow control. We are going to execute a 90-day cash flow audit. This budget serves as a blueprint for directing your income towards specific goals, rather than reacting to expenses as they happen. Group expenses into 3 columns. Essentials, like housing, is capped at 50%. Lifestyle and giving is capped at 20%. The remaining 30% is wealth building for savings and assets. Finally, highlight unnecessary junk charges. These are your financial leaks. Categorizing your expenses this way exposes where your income is actually going, allowing you to finally plug the leaks that are draining your capital. You have now audited your reputation, optimized your credit metrics, upgraded your banking tools, and categorized your cash flow. Here is the payoff. The money recovered from plugging those leaks is now rerouted away from unnecessary spending and flows directly into your wealth-building column. By following these pillars, you are building your financial life on a foundation of rock. When storms of economic pressure arrive, that foundation stays steady. This foundation is the starting line for long-term growth. Take the capital you just recovered and use it to fund your first income-producing asset to start building a sustainable financial legacy.